That's it in terms of the entry mechanics and the setup. Now, again, like I said, I want to go over really the results first because I think this will help you see the complexity of hedging and you can decide whether or not this is kind of worth the effort, right? So let's dive into, um, let's start with first the tab that is 2014. I think this will give a kind of a clear, we're going to look over all of these, but 2014 is a little bit more, um, I guess it's just the patterns are a little bit more easy to see where the spikes are. So 2014, you'll see that there is two cells you can edit. One's called allocation, one's called monetization. Allocation is basically what we've already gone over. The percent you put in here is basically whatever percent you're going to spend on long puts and whatever percent you're going to calibrate your theta engine to finance, right? So I'm going to set it to 1% for now just as a baseline. Obviously, you can budget for whatever, but this will at least allow us to look at it on the same level. So before I talk about the monetization, the net return, you'll notice that each of these tabs has three graphs. There's one called Vibranium Shield net return. There's the Hedge net return or net P&L, and then there's the finance campaign net P&L. So let's look at the bottom graph first, the finance campaign net PL. This is a fixed graph based on a back test of that year of the theta engine. And this happened to be at 90 delta, 90 DTE, 15 delta, same old 60% max profit to 100% stop loss. So it's pretty obvious to see that you can see the PL, there's a little bit of dip in the beginning of the year, and it climbs gradually through the late year, through October, and then there's a huge cliff, right? It goes all the way to negative, and then kind of climbs back and has a dip. So this, in 2014, I don't remember exactly what happened in late 2014, like December. You can probably just look on Yahoo or something, but that huge cliff in late October was basically the flash crash. That was the 2014 intraday flash crash. And if you go back and look at all the longitudinal studies, this wiped out the entire book, right? That's why there is this humongous loss. So this graph, the finance campaign, you can see pretty clearly, and it's kind of obvious to tell like what happened that year. Now, the more interesting one is the middle one. This is the hedge. So this is a graph of that same scheme that I mentioned entering the long puts. Now in E delta, I used a daily entry just to kind of get more granularity on the graph, but it was a daily entry, 90 DTE, and then exiting at 60 DTE, which is my best approximation of keeping the puts on 30 DIT. But so one thing you'll note is, and you can see that the PL gradually drops, right, to negative. And this is as you would expect, because when nothing's happening, you're just losing a little bit on the puts every single year. Sorry, over the year. And then in the flash crash, you see this spike, right? Now, it immediately goes back down, right? And it just kind of continues that downtrend. And then there's one more spike, and again, I forget what caused that at the end of the year, but it goes down. And you can see at the end of the year, your net loss is 0.75%. So the reason it's not quite 1% is because I think this was a rolling strategy. So at the end of the year, not quite all of the puts had expired yet, just based on the timing of when I started entering this on the backtest. But this just sort of make it clear what 0% monetization is. 0% monetization in this study is basically if you had done nothing, did not lock in any profits, did not cash out anything, just done nothing, and you can see that it puts spike and then they go back and they basically just die out. So here is the interesting part. What I did, and the purpose of these studies is to show you what if I had cashed out my hedge. And when I tried to come up with this study, right, I was originally going to just do like a manual backtest. And this is sort of a hybrid between a manual and an automated backtest. But remember, you never really know in the future how a crash is going to happen. So you have basically no chance in hell of cashing out at the peak, for example, right? So you just really don't know. And I wanted to give you guys a chance to look at what if I had cashed out, 10% of the profits, 20%, 50%, right? Or all of it, just for heck of it, just to see. So that is what the monetization percent input represents. What I did was I took the trade log, and again, if you look at this HPNL, you can kind of trace from the peak to the trough, or the trough to the peak, whichever way that is supposed to go. I looked at the two kind of spikes, and I calculated what the net unrealized PL of the hedge from those events. If you look in the logs, I call them like crash 1 and crash 2. I approximated what the net PL would have been, and I made it so that depending on the input of the monetization percent, it will actually add a certain amount of that unrealized PL into the graph. It's going to inject it so you can see what the hedge PL would have been approximately if you had been able to catch a certain percentage of the profit from those crashes. And now finally, the cool thing is the top graph, the Vibranium Shield net return, that is just a sum of the two graphs from below. So you can see if I increase, and I'll just go all in, I'll go 100%, right? You'll see that the Hedge PL graph, whereas it used to just drop off after the spikes, it now stays up, and then, it keeps part of that profit, right? And you can see on the Vibranium Shield net return, it kind of props up the whole line. And in fact, it makes it above positive. It's not a lot positive, and that's kind of one of the issues I want to get into. But for now, just understand that's how these three graphs work. And I'm actually going to go back to 2007 first, and we'll come back and revisit 2014. And just so you know, these years I picked, these were specifically kind of the quote-unquote bad years or crash years or years where the base theta engine / finance campaign didn't really do so hot. Because on the other years, as you would expect, on the normal years when there's no crash event, your income strategy is doing fine, right? So you don't really need the hedge. So those years aren't so interesting. I'll touch on that in a little bit, but let's look at 2007. This is actually one of the trickiest years. So if you look at this graph, one thing I want to point out is, again, so let's set the monetization as 0% and the allocation of 1%. If you look at the Hedge P&L graph, you can see that it's a slight dip, right? It's slowly losing money. I mean, there's obviously a crash right around February, but it's slowly losing money in the first couple of months of the year. If you look at the finance campaign graph, it's slowly gaining money, right? From, January through late February. And here's the cool thing to show you that this thing is really working. If you look at the top graph, the Vibranium Shield net return, it's basically like a straight line, right? It's going nowhere. And that thing, look, that's beautiful. That's exactly what this combo is supposed to do when nothing much is going on, right? It's showing you that the financing of this is perfectly covering the drag that you're paying for the hedges. So here is, you can see there's kind of three distinct spikes in this year. There's one in March, there's one around mid-August, and then there's one in mid-November. And this year in 2014, you can see that, that's clearly reflected in the finance campaign P&L, because you can see three kind of distinct drop-offs. And this thing is actually, honestly, one of the more interesting studies I've made, and it's kind of cool because the finance campaign is sort of a proxy for the market, right? Because obviously with the short puts, it's correlated to the market. And then the hedge P&L is sort of a proxy for volatility, right? Because these are long puts. And so you can kind of see that these two are the inverse of each other. When the hedge goes up, the finance goes down, and vice versa. And so again, that's just kind of a neat thing about this. But let's look at the actual P&L. If you don't monetize any of the hedge, right? So the hedge is down 0.4% that year. The finance campaign is down. I'm just looking at the very end of the graph. It's down about 0.16. So that the combo is down 0.58. So what does that mean? That means if you were to run the Vibranium Shield at a 1% allocation, meaning you're trying to spend 1% per year on the long puts, and you're trying to finance it with 1% target return for the theta engine, and you just happen to fall asleep and don't monetize anything, you'll see the net return, negative 0.58%. And this is the risk with running something like the Vibranium Shield. This is where it comes back to, like, when people say there's a free hedge, no, there isn't, right? There is times when both things lose. Now, yes, I haven't done any monetization yet, but I just want to let you know what you're looking at and what this represents. So if I were to spend 1% per month rolling these long puts, 1% per year, and try to finance it with something like the theta engine, in 2007, you basically would have lost, right? This actually would have added to the loss or the drawdown or to whatever else you were running. So one thing I want to figure out is, like, so how much do we need to monetize? Because remember, you can't expect to catch perfectly the peak of all these crashes. So, if you can play around with this, right? I'm going to increase the allocation, the monetization 10%, 20%, 30%, and you guys can do this. You can see the hedge P&L start to rise, and it's starting to prop up the net return of the Vibranium Shield net return. Right now, if I remember correctly, 2007 needed, so you needed basically 80% monetization just to not lose money. One of the goals for running and designing the strategy, because if you're going to hedge, you don't want the hedge to actually hurt you, right? You don't want it to actually just cause more losses. But that's always going to be the risk if you're financing. Because what is financing? You're just taking on another risk. You're just running another income strategy. So in 2007, basically, unless you got lucky or, yeah, really, it's luck. There's no skill here. If you got lucky enough to catch and cash out most of the profit from the hedge, you could at least scratch, right? You're not even making a profit. You're just scratching on this combo. And for me, that's okay. Again, you just want to do no harm. But why did this happen, right? Why was this year so tough? Basically, in 2007, again, I didn't really trade through those years, but looking at the way volatility, didn't really pop, and you can see, because this is real world data, right? You can see that in March when there was a sell-off, yes, there was kind of like a spike in volatility, so there was a decent amount of profit to be gained from the hedge there. But looking at kind of the mid-August, early September, there was a pretty big, I guess there was a pretty big sell-off, right? Because you lost, like, it was probably a full book wipe on the data engine portion, but volatility barely popped, right? And so that second, I call it crash one, crash two, crash three in the log, but the second one really wasn't a crash. And it was in November when you had another leg down, and that probably wiped out another half of your book. That was when volatility kind of popped again, right? But this kind of early fall area where you see the market sell off but volatility didn't really pop, that's what creates these dead zones. So you can imagine during that second leg down in the middle of the year, all the losses from your theta engine and the entries you were getting stopped out, those were likely from kind of delta or gamma exposure, not so much vega, right? Because the long puts just weren't activating. And I think when I go back to the trade log, I was seeing that you had a lot of entries which were pretty much getting stopped very late in the cycle. So there was this long grind down that finally just stopped out a bunch of entries, but volatility just wasn't picking up. So that is always the risk when you're trying to trade these kind of hedges, which are really low delta, right? You need a big move to really make them pop. And this year it just didn't happen. So 2007 is basically one of the tough years. So let's go to 2008. This one is not so interesting because 2008, the really mega blacks one years, it's pretty much a given. So I'll set this to, again, 1% allocation, 0% monetization. 0, just for context, is I think this year, pretty much no matter what you did, you're going to cash something out because it's such a big crash. You can see the finance campaign lost about 0.92%. If you don't monetize anything, obviously you look at the graph, there's a huge spike, everything bleeds out, and the hedge is negative 0.4, which is why you have a negative 1.33% loss. But again, that's really not practical. In 2008, things were going crazy. You were definitely going to try to cash out something at some point. So again, with this kind of study, I wanted to sort of establish kind of the minimum baseline to like, what did I need just to not lose money on this combo? So if I up the allocation to 20%, let's do 30. Yeah. So 30% monetization would basically get you a scratch, right? But that year, there was such a big drop and volatility spiked so much. You can imagine, even trying to catch half of that, 60%, is probably reasonable. Definitely not 100, but for example, if we were cash out 50%, so you would make about 0.8% return per 1% allocation, right? So this is actually finally seeing kind of like a net positive return. So meaning if you ran the vibranium shield at a 3% allocation, so I'll do 3%, and cashed out 50%, you would basically add 2.4% to the bottom line of your return. Now, that doesn't look super great. I will say one thing, where this is me trying to make a simulation out of static data. So there is some, I will say this, the way I was doing it is probably a little bit conservative on the profits. So in reality, I'm pretty sure you would have made a little bit more, probably closer to like, just kind of looking at the peak of the crash here, probably more like 5 or 6, maybe even 7% return. So again, not like a huge amount, but remember with these things, you never expect, you never really predict what's going to happen exactly. So to make anything back on your account, so let's say your account had a 20% drawdown and you were able to make 7% back or 8% back, that's almost cutting your drawdown in half, right? So the idea is you just have to have like realistic expectations on these. And that's why, at least with this sheet, the way it's set up and the way you can kind of play with the numbers, you can get some context just to see like what it takes to actually make money with a financed hedge. 2014 we talked about earlier. The only thing I'll add is that just this year, if you look at that flash crash, yes, it was an intraday flash crash, but I suspect because it happened so fast, volatility didn't have that much, it didn't expand that much, which is why like you lost a whole book in the finance campaign, which is why you just had such a big loss. But even at the peak volatility, so if I set this thing to 100% monetization, it's still barely making my net return a scratch. So I think again, it's kind of interesting to see these things play out in real life. That like, if you go back and imagine, oh, if this flash crash happened, would I have made a bunch of money if I had been hedging? And this kind of shows that no, you really wouldn't. So, and 2014 was kind of a weird year, anyways, because I think this kind of like 20% drop in 12 minutes or whatever it was. I mean, it's not really supposed to be possible anymore, anyways. So I wouldn't put too much weight on this year's results, but I had it here just for context and just kind of curiosity's sake. Um, the rest of these we can move on pretty quickly because you kind of know how these things work now. 2015, pretty obvious one. There was a huge drop in the late summer, August 24th. There was like two really big down days, followed like a third day that gapped down 5%. So volatility had a huge spike. Um, this year was interesting because if you look at the finance campaign, even though it had a pretty big drop mid-year, it still actually ended up positive for the year. So this year, if you practically didn't monetize anything, in fact, I have it set at 0 right now, it's about a scratch. So if you're able to capture any of the hedge profits, you're good for the year. This combo actually made money, right? So I'll just set it at 50%, for example, and it made about 0.65%. So if you captured any of that, half of it, you're going to make, 0.65% return net on this combo for every kind of 1% allocation you are doing for the hedge. 2018, this was again a tough year. If you guys remember, there was the Volmageddon event in early February, and then that grind down in Q4 that was really annoying. A lot of people had it was causing losses, but hedges just weren't really activating. And again, this is 2007 and 2018 ultimately were, I guess, kind of what I actually consider the black swans in terms of hedging, because these were years where you were probably losing on your income strategies, but the hedges just didn't really do much. Looking at the graph, you can see Volmageddon definitely had a peak, so that helps if you were able to catch it, because that was a pretty fast event, and VIX went to 50 for like one day. So again, unless you're doing something automated, like you may not even have a chance to catch much of that spike, right? But the grind down that started in, let's see here, early October, the first leg down, if you look at the finance campaign graph, a huge plateau, but VIX, right? I mean, not VIX, but the hedge P&L barely picked up, right? And you had another huge leg down in late December or early to mid-December, and then the volatility picked up. But again, that year, it just wasn't that much. I remember all the way from early to mid, right around Christmas Eve, volatility was like barely going up. VIX was going to like, I think it peaked at like 38 or something. It didn't even break 40. So, and I did have other hedges. I was using the Black Swan hedge back then, for example, and it just wasn't really doing much. So this was a really tough year. And again, I'll let you guys play around with this to take a look, but let me just see what it would take to at least break even that year. Yeah, 60%. You had to monetize 60% of all of the crashes to just not lose money. So again, very tough year, and I see this year and 2007 as kind of the real risk to running something like the Vibranium Shield, because you're just gonna most likely end up doing a little bit of harm to yourself rather than good, right? Trying to have this hedge that just doesn't work on those 2 years. And lastly, and honestly, the least interesting one is 2020, because this was really a gimme year. If you look at 2020, it was such a fast crash, and actually the finance campaign ended up quite positive that year. And the hedge P&L, again, if you set it at 0% monetization, you obviously see a huge spike, and then it just drops down to like negative 0.7. And if you monetize any of that, you're going to be positive. So this was kind of a weird year where like, even if you didn't hedge or didn't cash out any of it, just that extra allocation on the Vibranium Shield, the financing portion, by some miracle ended up positive, right? So just to run one for the heck of it. So right now at 1% allocation, if you monetize even half of the hedge profits, right, you got 3%, 2.9, so 3% profit, right? So if you ran a 3% allocation on the Vibranium Shield and monetize even half, you're adding 8.7 or almost 9. Again, this thing is conservative, so honestly, I would say you're probably adding almost maybe 10, 12% to your bottom line, to whatever else you're running. So again, I think the super crash black swan years honestly aren't that interesting, because we know if you're buying long puts or teenies to hedge, they're going to hedge, right? On a crash year, they're going to hedge. So really the challenge is seeing on the not so crash years and just the other years, what exactly is the trade-off? Where is the risk? Now, last note before I let you go, I know this episode is pretty darn long. What happened on those other years where there's no crash, right? This outside of the 6 years I focused on in this set of spreadsheets. So if you go to the bomb shelter page, because that has the longitudinal study for the 90TT theta engine. So I'm looking at this because again, the theta engine is the core component that actually finances the long puts. So I have this set at a 1% target return. I just want to show you what would have happened to the finance portion on those years, right? So 1% allocation means I'm spending 1% per year on the long puts. That's my expected loss. And I'm trying to finance it with 1% return on the theta engine. So in 2005, you would have had a 1.7% positive return on just the theta engine, meaning if you subtract out the 1% you spent on longs, you have 0.7% surplus, right? It actually made an extra net return. So rather than just, you've essentially overfinanced the hedge and actually made more return. So that again, those years are gimmies, right? Those are just, you're just making more profit. So not really that interesting, but I just want to give you the numbers. 2006, 1.4% return. So net surplus of 0.4. 07, 08 we talked about. 2009, 1.7%. So net surplus of 0.7, right, per 1% allocation. So it means if you had a 3% allocation, you'd have a net surplus of 2.1%. So all that's just extra return on top of whatever else you're doing. 2010, 1.2, which is a surplus. 2011, 1.1. And so basically you can go to the bomb shelter page, pop in a return, and any return on that year over the target, that's essentially the surplus, right? Because that's above and beyond whatever cost you need to pay for the hedge that that you're buying during that year. So I think I should leave it here. I know, where are we? This is a really long episode because again, I will follow up with two episodes, one on the hedging, more specifics on, the nuances of buying the hedges, and one on the nuances of using the theta engine to pair up and finance it. But again, I wanted to go over these spreadsheets and these studies because there's a lot of nuance and really to help set the stage and give you the context of what exactly you're even going to be looking to do with this if you decide to run it.